Hello, Business 635 students. This is Professor Hassey. It's Thursday morning of our week number 7, and this is our week number 7 update. I have a lot to go over this morning and a little limited time due to the capabilities of our technology here, but let me get to it and start the ball rolling. First thing off, your electrics case. Due in a couple of weeks. You should be beginning to look at that and understand that. I have posted a checklist for that case, the electrics case checklist. You should go through this list one after another and find the appropriate areas that is required. You get through this, you'll be able to write your paper and answer those questions in the analysis that I provided. The WAC, the dollar amount of the investment, the project life. Some of this stuff is right in the case, just reading it. Others is you have to put it together. I'll have a separate video this coming weekend on the warranty to be posted on Monday of next week, because the warranty cost is one of the more challenging aspects of the variables in this case. So look at this checklist, go right down it, see if you understand it, put it together, and we can go forward with that with our paper. I will be having a review session next on Sunday, March 1st. Sunday, March 1st, on the Laverne campus, and the time is yet to be decided. But that review session on Sunday, March 1st for the electrics case will be a WebEx call-in session too. You can call in on WebEx and ask any questions or hear my review of the electrics case. I'll be posting information about that early next week, but we will have a special review session for the electrics case on Sunday, March 1st, probably in the afternoon. I'll be getting a room on the Laverne campus, but also that room will have access to WebEx, and you can call in and watch my lecture on the review for the electrics case. Stay tuned for that. Another task this week is the case number 3, which is further practice of the capital budget risk analysis that you are also doing in the electrics case. This is a little bit more concentrated. You can use the template that I provided in week number 6. Here's that template here where I calculated the WAC, and here's the WAC, weighted average cost of capital calculation with the formulas in the cell. Then I went ahead and used that WAC in determining the investment of $1 million in these variables, producing an NPV, IRR, profitability index, and payback. The calculations in the cells to do that is a good template to review. Then we do a risk analysis. All right, the risk analysis is a scenario analysis and a sensitivity analysis based on the data given in the problem right here. Here's your risk analysis and sensitivity analysis information. So this is a good review template. I've also given you blank folders where you could do it yourself, where you could put in the information and do it yourself, and you can use that as a check figure with the tabs I have given you. Same thing with the risk analysis. You can do these, fill in these sheets, do the work, and compare it to the answer problems I have. So this week number 6 template is a very good review of the capital risk analysis process. So you are doing this in case number 3 due this weekend. Again, and also you're going to answer 3 questions. These 3 questions related to a couple of the articles I had you read last week. Relate those articles to the work in this case. All right. I would like you to do all your calculation work in a spreadsheet, then answer these 3 questions, preferably in a Word or PDF document in a separate file that you will post to Blackboard for your answers. And here's the case. You are asked to calculate the WAC with these certain variables, determining the capital structure, determining the after-tax cost of debt, and determining the cost of equity, weighting those into a weighted average cost of capital. That'll be your discount rate and your rate used in your analysis of a $400,000 investment over 5 years, depreciation, salvage value, and the inflation rates involved in each one of these variables, Remember, in the electrics case, it's one inflation rate, but here, multiple inflation rates. Selling price, fixed cost, manufacturing costs. Once you do that base case analysis, then you do a scenario analysis, and then you do a sensitivity analysis. Follow the template used in last week's week number 6. You should be able to put all this together and determine the final analysis of this case, and then you can answer these 3 questions involving the case. Again, the template I provided in week 6 is a good example of this. Here it again is right here. Use that to determine your numbers. If you have any questions on that, please let me know. Finally, our topic this week is leasing. Now, leasing is one attribute of this that I'm concentrating on this week, but leasing is a form of additional financing that companies can use to create assets. A lot of you probably work for companies where many of your HR services, your payroll services, your accounting services, your janitorial services are all subcontracted out to other agencies. An example, at the University of Laverne, we use ADP to do our payroll services. We no longer have a payroll department. We have one person called payroll who gathers all the payroll information and sends it to ADP, and they process it. All right, that's subcontracting. It's going off site to do a lot of your work. Well, companies are doing that now in regards to assets and financial resources. They lease equipment. They lease telephone systems. They lease computer systems. And that leasing is not the purchase of the asset that they own, which they do not get a depreciation expense on it, but at the same time it can fit into their budgets, and they include those costs of the leasing as an operating budget item instead of a capital budgeting item. Leasing, the leasing and renting of assets is quite prominent, especially in small business these days. Small businesses cannot afford debt. They don't have the credit to get debt. So leasing is an alternative to that type of financing. So it's a good thing to know that another strategy of owning assets and financial resources can also be leasing. And that's one of the key attributes that we're studying this week. Here's an example of that taken from chapter 19 of our textbook. Oh, let me get that here. There it is right there. And this spreadsheet is included in the note in our class notes for week number 7. And we will be having a question in this regard next week in case number 4 on this topic. Here's a lease. The question is, do we purchase an asset of $1.5 million right here, or do we rent or lease an asset of $1.5 million? Naturally, when you purchase an asset, you have to fund it, borrow the money. You can get a depreciation off that asset. Here's a marginal accelerated cost depreciation schedule for this 4-year asset. You also have salvage or residual value of that asset. You also have interest on the debt that you can deduct. A lot of different alternatives when you purchase an asset. When you lease an asset, all you have is the lease. No depreciation, and fortunately no loan, no residual or scrap value. You just have the lease. Notice in this case, it's $108,000 cheaper to lease this asset. All right. The tax shield is your interest and depreciation. The loan is an unamortized loan with interest only, with the principal due at the end of the life of the loan. The lease is just strictly lease payments after taxes. You get a tax deduction on lease payments because it's an operating expense. When you take all into account, you do a discounted cash flow analysis. Just like we're doing in the case number 3 this week, you do a discounted cash flow analysis to determine today it's costing me $885,000 at my cost of capital, which is 9%, to buy this asset for $1.5 million, take into account all the tax shields that you get off that, interest and depreciation. But to lease the $1.5 million asset, taking into account the tax shield of your lease as an operating expense, it's only costing you $777,000 to rent or to lease that $1.5 million asset. Thus, it's cheaper to lease. Now, for most small businesses, this is the way they go. It's cheaper. Now, naturally, if you get bigger assets, go out longer periods of time, interest rates drop based on your credit, it becomes more attractive to purchase the asset than lease. But for most small businesses, this is the way to go. And this is one of the ways of another financial resource for a company is you can lease the asset, get the same revenue and return out of it, but you don't have all the hassles of borrowing the money, keeping track of all the cash flow requirements of the tax shield. I want you to study this spreadsheet. Try to understand what we're trying to do. We're trying to compare the ownership of a resource to the leasing of a resource. A very important strategy for business. Okay, we've covered a lot of topics in a brief 10-minute time, but again, look at that checklist for the Electrics Incorporated. Begin to work on that. We will have a review session on March 1st, Sunday, for anybody who needs help on that. But also, you can always ask me for questions at any time during the course of the week. Remember, we have WebEx office hours on Thursday afternoons and Thursday evenings. You can participate and ask me questions then. We also took a look at case number 3, which is practice for the electrics case, providing a spreadsheet and answering some questions that are relative to the articles you read last week. And finally, we took a look at leasing, other sources of financial resources that you can do that requires non-ownership, but you still get the value of the return of the investment without the hassle of the debt or the cash flow analysis. So please review these things. We'll talk to you about it early next week. I'll be available this evening for office hours if any of you need any help. Thanks again, everybody. Have a great rest of the week. Bye-bye.